Hi, this is Ryan and Tom with our monthly video, and been hearing and seeing some things with clients going on. We figured we'd talk about it. So, what's the topic for this?
On the asset map, we get to the insurance a little bit. It's amazing how little most of our clients know about what they have.
It's sort of a checkbox, like, hey, I have the insurance on the asset map, and I'm going to set it and forget it. But that's not always the case. You actually need to be on top of it, review it, and what are some of the things that we've seen?
Well, I have a variable life plan that I've had for years, and it has an insurance component and it has an investment component. And I'm always making them run illustrations every year. And one of the things you want to make sure it's not underfunded. And you do some of these illustrations and you say, if I put an extra $3,000 in it, how does it look?
Now, did you have to call your agent for that, or who's your agent on that policy?
Well, I'm the agent on that one, so I can't. But usually clients don't know who their agent is. The guy's long gone. It's a friend. It's a family member.
They sold them a policy, and then they're off to the next.
Typically, what do we say?
A lot of times beneficiaries aren't up to date, or they don't even know who the beneficiaries are. You mentioned policies are running out of cash. They haven't ran an in-force illustration. Most of the time when I mention in-force to clients, they have no idea even what that is.
And the trick with that is we have to have the client sign a letter, and we have the letter, but they have to sign the letter. We send it to the insurance company. We tell them how we want it run. They run it and then send it back to the client. The client gets it to us, and we see what the heck it really says.
I've even seen the opposite, where the client's fully funded, they're still making premium payments, and they don't need to necessarily.
Right.
So they could tone that back and use that money for cash flow for other things. Term policies are a little bit different, though. They don't have that component to it. So you want to talk a little bit about what we see with term policies?
You know, most people have like a 10-year term or a 20-year term, and it's amazing. 20 years goes by pretty quick, where you wake up and you got 4 more left, and you're like, okay, am I insurable anymore? Because that's, what's important at that point. And we've seen ones that they're not insurable anymore. And the renewal premium, instead of being $400, it's $12,000.
Huge increases in premiums. Absolutely, especially if you did have a 20 or 30-year policy. You're 20 or 30 years older, so the premiums are going to increase.
Another one, too, as far as increases, I just saw one where an insurance company is applying to the state of New Jersey on long-term care, different subject, but on long-term care for a 684% increase. Now, they may not get all that, but what they're saying is it's a juicy lifetime benefit plan, and we don't want you to keep it very much longer because we're losing money.
And I think we should talk about that for a second. What's the difference between those lifetime benefit plans versus what they're offering now?
Well, you can't get the lifetime, but they would literally pay you $2,000 a month for the rest of your life. A few companies woke up years ago and started repricing it. Now they all are. They're all running away from it.
And now most of the time it's either a 3-year or a 5-year is kind of the maximum of benefits that they'll provide you for.
And that's sort of, then people say, is it even worth doing?
Switching gears, what about these annuities? Tell us a little bit about the annuities that we've seen.
Not just annuities. All this stuff has costs. And people say, well, I don't pay anything other than the premium. Well, a lot of costs. One is, what is your surrender penalty? And they look at me like, what do you mean surrender penalty? Most policies, if you get out early in the game, they're going to take money out. Some agents can charge you 3% kind of number. Some agents have a 12-year surrender penalty, which means you're in there for the long term. You better like that company, and you better understand the product. But then there's how all annuities and all insurance companies make money, the M&E. What's M&E stand for?
Mortality and expense rate.
And that's about 1.2 to 1.4% in all the annuity contracts. On top of that, some people will say, well, I'm going to buy a death benefit rider or a guaranteed payout rider. That's another 1%. Now we're up to 2.4, let's say. And then if you're in a contract that has investment accounts, there's another cost in there that could be as high as
one, more than one I've seen. So yeah, I mean, you got to be careful with what you are buying. The bells and whistles sound great, but a lot of times they're more expensive, and do you really need them? The other thing is, if you're going to get locked in for 12 years, your life is way different 12 years ago than it is today, and it'll be way different 12 years from now. So how do you justify locking yourself in for that long?
And I think some of the agents that are selling it, who may work at a bank, and they're selling what they're told to be selling, there are surrender penalties and most of that stuff. They're going to take the thing that they make the most money on, too. So the longer the surrender penalty, the more commission they'll make from that selling that product.
Yeah, generally that's the case. And most of the clients don't understand what riders they have. Is it a variable? Is it a fixed index? There's all different variations of annuities, and you really won't know until you see a statement and you get the in-forces ran and figure out what you have.
So what we're doing in our reviews is we're looking at, sort of what do you have? What do you think you have? Who do you think are the beneficiaries? And then trying to do some analysis on it. Give us a call. If it comes up in your review, we can talk about it more. Have a look at some of this stuff where you're going to wake up down the road and it's hard to fix down the road.
So thank you, and we'll see you next month.